Do you want to keep up to date with the latest SMSF news? Then you should subscribe to SMS Trustee News, a fortnightly online publication that will keep you in touch with the latest compliance issues, strategy considerations, and investment opportunities for SMSFs. A subscription will empower you with all of the latest information to help run your super fund a little bit better. So please subscribe. Just go to the website smstrusteenews.com.au. Now, I'm not sure, this is a bit of a reminder, I'm not sure if any of you have actually attended, logged in, asked questions to our SMSF Fast 5 sessions. So we've introduced that this year. It's just really to try and create a forum or a community where if you've got questions about your SMSFs or investment strategies or retirement strategies or anything like that, we're kind of introducing you to some specialists who cover all of that within the industry. And I'm talking about like really top grade practitioners. So some of them will be here today. If you want to go and ask them any questions, I'm sure they'll be more than happy to answer your questions. Their table is just sort of behind that wall there. So if you're a fan of that and you've got some questions that you want to ask but weren't able to previously, then please take that opportunity. We're very pleased with the Fast 5. We're quickly building that community, and we encourage you to join that community because that will be an opportunity to compare notes, ask questions. You know, it's not always easy to ask questions, and sometimes it can just be something that pops up. So you can go on there. It's a Facebook community. I encourage you to join it. And our practitioners are really vigilant too. Once you put a question on there, bang, they're onto it. So you will get some results if that's what you're after. Well, that's enough of the introduction. I'm going to just run you through a bit of the SMSF environment as it stands right now before we get into some of the other presentations. And really, when I was going through what I'm about to speak about, I was thinking to myself, it might be actually easier to cover what's not changed than what has changed, because probably since the 1st of July being the marking point, there has been so much legislative and regulation change to the SMSF sector. It's been quite unbelievable. I will say this, it's all positive change. So a lot of it will enable you to be exposed to new strategies, particularly contribution strategies, that you may not have been able to do before. So that's really opened the gate, and I welcome that, because my criticism of the system was always that when people could actually afford to put money into superannuation after they'd finished with their financial commitments, such as putting their kids through school and paying off their mortgage, they didn't really have an opportunity to do it, because that's actually when the contributions were restricted. So some of these changes have been really positive from that point of view. So I might just touch on a few of them. The work test rule change is probably the biggest one at the moment. So just to quickly summarise on that, you used to have to satisfy a work test if you're over the age of 67 to make any non-concessional contributions. That's now been extended to people up to the age of 74. So you can make non-concessional contributions without satisfying the work test. You still have to do it if you want to make personal deductible contributions, but you don't have to do it for non-concessional contributions. Now, there's been a slight shift in the way legislation's been written or covered right now, or the way it covers the sector. It's now covered under the tax law, which is why that's changed. But even though there will be a lot more contribution possibilities for you at that later stage in life, you must take into account that the total super balance thresholds still apply. So make sure that you're aware of that. If your total super balance is above 1.6 million at the moment, I think it is, you can't make any non-concessional contributions. So don't be a little bit confused that it's open slather. It's not. There are still some limits, but really that work test change is a huge fillip for the industry. And of course, I touch on this because Julie Dolan later today and Tim Miller will touch on these subjects a lot more. May seem a little bit strange, but the work test change has actually opened up a lot of estate planning opportunities. You wouldn't immediately think about that. And Tim will also touch on some of the contribution strategies that you can go forward with now that's open to you. Sort of in line with that, the non-concessional contribution bring forward provisions have also been extended to that cohort up to age 74. Now, this was a really welcome thing by the sector. All of the presentations that I had attended in the lead up to the 1st of July were sort of speculating whether or not this provision would be phased out as you got up to the age of 75. But it hasn't. So depending on your situation, again, depending on your total super balance, that bring forward rule of 3 years worth of non-concessional contributions will be open to you right up to the age of 75. So at the moment, 1 year's worth of non-concessional contributions is 110,000. The rules are that if you trigger the bring forward provisions, you can contribute up to $330,000 in 1 year. So again, another great initiative to encourage older Australians and Australians who can afford to put more money into super to be able to do it and to hopefully enjoy the tax effective status of super as they move into their retirement years. Now, another contribution related measure that has come into place from the 1st of July are the downsizer changes. So when the downsizer rules were introduced, they were only available to individuals who are 65 and over. From the 1st of July, that was reduced to 60. Well, the qualification age was reduced to 60. So now if you're 60 and over, you can make a downsizer contribution, which is basically a maximum contribution of $300,000 that you can make from the proceeds of sale of your of a property that you've owned, a residence that you've owned for 10 years, effectively. Now, this has been a very, very popular contribution strategy since its introduction, I think in 2018, I think it was. We've seen a lot of people take this up, and politicians being politicians obviously seize on popular policy and want to, well, maximise, I suppose, the political capital that they can get out of that. Now, I'll just mention that on the 1st of July, the age dropped from 65 to 60. Well, just before the election, the then coalition government said that, we're going to drop downsizer qualification age to 55 if we get re-elected. And the Labor Party almost immediately, it took about a nanosecond, I think, for them to say that, we're going to do that too if we get elected. Now, I personally didn't think that it would have been a high priority for them because, as we well know, there are a lot of other things economically that they have to manage right now. But the bill has already been tabled in Parliament to reduce the downsizer age down to 55 now. It hasn't been passed into law yet, but it has been tabled in the lower house. Now, as the age drops, there's one thing to really look out for. As the age drops, you're going to have to be a little bit careful with when you make this sort of contribution, and it's going to have to be a little bit more strategic than it was in the past. The reason being, I mean, if you sell your house when you're 55 years old, there's a good chance you'll buy another house and you could own that property for another 10 years. So the ability to make a downsizer contribution all of a sudden extends into a different time horizon. And another thing to watch out for is that the total super balance is something to be careful about, not for the downsizer because you can contribute the $300,000 regardless of what your total super balance is, which is what makes that rule so popular. But it's something to consider with the rest of your contribution strategy, because if you make a downsizer contribution, it puts your TSB over a certain amount. It may restrict you from making any further non-concessional contributions, and of course, potentially triggering the bring forward rules in later life. So while it's a good thing that more people can access that, all of a sudden it's been given a slightly different dimension. Not sure the pollies totally understand that, but it's slightly more complicated than it was. I don't know how much that will impact the popularity of the measure, but I have absolutely no doubt, I'm a journalist, so I am a little bit cynical, that they are looking to maximise the political capital that they can get from that very popular measure. Now I move on to something that's quite contentious, but I'm not 100% sure exactly how relevant it will be to the people in this room. If I have a criticism of the sector, is that we tend to talk about a lot of things that are important to us, but not necessarily that crucial to the wider SMSF public. And I'm talking about the non-arm's length expenditure rules that you might have read a little bit about. They've been contentious. They were supposed to come in on the 1st of July 2018. They're still sort of in limbo. Basically, in a nutshell, the ATO has extended the provision where if you've acquired a property within your SMSF, and I don't know, there might have been a management fee, or you might have acquired it as what Australians like to call mates rates, then they don't think that it's been a proper recognition of how much that transaction should have cost. And in doing so, that will actually trigger the non-arm's length income rules for that asset. And that means that that asset, income and capital gains, will be taxed at the maximum marginal tax rate, being 45%. 45 versus 15, not a very good comparison. The contentious part of this, though, is that the application is to general expenses as well. There's this thing in the rules called a nexus. So you've got to create a connection between the expenditure that they're looking at and the income of the fund. And when we're talking about general expenses, we're really talking about things like administration expenses. And there are some sweetheart deals out there. A lot of professional organisations, if you're a member of a chartered accounting firm, or if you're a partner, sometimes the firm does your SMSF administration free of charge. It's one of the things that they offer their staff. Now, of course, not everybody gets admin free of charge, and that would obviously be deemed as, well, you haven't incurred expenses at a arm's length or commercial basis. Now, the issue with that is that the nexus with general expenses is the whole fund. General expenses aren't limited to just one asset. It's not just like a property or a bundle of shares where you can say that, well, yeah, okay, it applied to that, but I can probably live with that. It's only one section of my portfolio. These general expenses, that applies to your whole portfolio, which means that all of the income of the fund, capital gains and income, will be taxed at 45%. Now, this has been causing quite a bit of angst, as you can probably tell, which is why no one's moved on this since 2018. There's still debate going on. The Liberal government did say that, look, we're going to review the whole situation, but of course they've been voted out. So we didn't get any commitment from Labor, but there is a positive here. If you are caught by this, or you are a little bit worried about this, the industry fund sector has now realised that this has got implications for them, because they outsource some of their admin, and they're worried that, well, if we get discounted rates with that outsourcing, we could be in a little bit of trouble with these non-arm's length expenditure rules as well. So again, not to be cynical, but we've seen this all in the past, that the ALP do tend to favour the industry fund sector. Certainly not been great fans of this sector in the past. But if the industry funds get in their ear to say that, hey, this is not such a fair and equitable thing to do, I'm pretty sure that they're going to pay attention to them. So we actually might get a resolution quite soon on this, sooner than probably we expected. So watch out for that one. Hopefully some common sense measures. I know that the SMSF Association has been lobbying hard on this for some common sense measures to be put in place, because that penalty of 45% tax on your fund, or on a particular, even on a particular asset in your fund, I think we'd all agree that that in no way is commensurate to the breach that they're looking to try and catch out here. So watch this space. The minute it'll be announced, we'll all be talking about it again, and hopefully we'll get a good resolution from that, because I know it's certainly been causing a lot of angst within the sector. To its credit, the ATO has not enforced any of the non-arm's length expenditure rules right now, and they have committed to not committing any enforcement resources to it until the 30th of June 2023, which is really only until the end of this financial year. So again, that length of time is shortening, so we hope that there will be some resolution on this issue that will give us some sensible rules around this. Now, one of the other things that was announced recently was the change in the transfer balance accounts reporting timeframes. Now, this only applies if you're in pension phase, and it's basically only if you have a pension and there's a change to it. So we're mainly talking about commencement and commutation of pensions, or partial commutations of pensions. So basically, when the rules came in, if you had members whose total super balance was under $1 million, then you could do your transfer balance account reporting on a yearly basis, which meant that you could file that report at the same time as you did the annual return for your fund. Well, this has changed now I suppose in the name of simplification. I should say that anybody who had members in pension phase whose TSB was above $1 million were quarterly reporters, which meant that any change to your pension, you would have to report within 28 days of the end of the quarter in which it worked. Now, from the 1st of July next year, so 1st of July 2023, everybody will be a quarterly reporter. So no more yearly reporting for transfer balance accounts. That's not such a bad thing in itself, because everybody will be on a uniform basis. The bit that may cause a little bit of pain, will cause a bit of pain, not may cause a bit of pain, is that the transition phase of that new time frame of reporting is very, very strict and unforgiving, is the way I would describe it. Unforgiving, why? Because if you're a yearly supporter, you're chugging away, everything's fine until you get to the 30th of June 2023. Now, if you've got transactions to report, you might think that, oh, well, at least for that year, that's the last year that I've got the yearly time frame, and anything going forward from July 2023, I'll do on a quarterly basis. No, there is no transition, basically. So any pension transactions that you have to report via a T-bar, you will have to do anything relating to the 2022-23 income year, you will have to do by the 28th of October, excuse me, being 28 days after the end of the quarter, which is effectively the end of the year, being September, that you'll have to file your report. Now, that will cause a lot of pain. When you consider that you had way into the next year usually before you file your annual return, all of a sudden to have to turn something around by the 28th of October is going to be difficult. We're going to have situations where potentially you're not going to have the information to put the transfer balance report in, T-bar in. So a lot of use of estimates and that sort of thing is going to have to come in. That's reality. And so a different sort of mindset. Again, it's only when your pension situation changes, but that is a very, very tight time frame, and I think we're going to see a lot of people struggling with that. Absolutely no doubt about that, I don't think. Now, you might have seen some promotional videos in the lead up to this event to do with the next subject that I'm about to talk about, and that's director IDs. Now, very thankfully, and this is a very good development for the sector, I think the majority of SMSFs now have a corporate trustee structure, which is the more prudent thing to do rather than individual trustees. That means obviously that you'll be directors of companies who act as the corporate trustee for the SMSF. Now, with the director ID number regime, if you were a director of a company before the 31st of October 2021, you have until the 30th of November 2022 to apply for a director identification number. I don't know how many people in this room have tried to get a director ID number. I have. Now, I confess, and Cynthia and Jenny will both tell you this, I'm not the most tech-savvy person in the world. The government would like us to do it via the MyGov ID app. That's completely different to the MyGov app or account. So that's one thing to be conscious of. They say it takes about 20 minutes. I tried it. I didn't get to the end of it, and it wasn't that straightforward. And I mean, I've been privy to a lot of discussions around this stuff, including sitting in on a seminar from a product provider that talked us through how to do this, and I still couldn't get to the end of it. I have been asking questions about this. I asked one mid-tier accounting firm, and they basically said that we are advising our clients to fill out the manual form and send it in via mail. To me, that's a much more appealing option. It is expected to affect 388,000 SMSFs out there. That's an estimate, but that's a good chunk. That's nearly half, or just over half. And some really good initiatives being brought to market right now as this time frame shortens. One of the misconceptions, I think, was that the message was that you have to do it yourself, right? That's not always that easy, especially when SMSF trustees are of a slightly older demographic, so not that great with doing apps and stuff on your mobile phone. So that's always going to be an issue. The other thing was that we were told that you have to do it yourself, which meant that it was interpreted in a lot of ways that your advisor couldn't help you. The reality of the situation is your advisor couldn't do it for you, but there's no reason why they couldn't assist you. Now, to this end, the SMSF Association has just actually released a white labelled document to help advisors, help people get their director ID numbers, because this is an issue. But I know that some of you will be attending today because we've got some of the manual forms to give to you. So for the audience online, if you want them, I know some of you are interstate or have already expressed to me that you would like to fill out a manual form to get your ID number. Don't worry, I've got your emails and we'll make some arrangement there too.